Thank you. Hello, everyone. Thank you very much, first of all, for including our paper in the program, and a special thanks to the organizer for accommodating this online presentation. And thank you, everyone, for listening, although I cannot see you, but your comments are very welcome. Unfortunately, all three of us cannot be in the conference in person as we are all outside the country and face various travel restrictions. So we really appreciate this accommodation, and I hope everyone is enjoying this great conference. I am Xiang from the University of Hong Kong, and this is a paper with Yang Liu, my colleague at HKU, and Roussanov from Wharton. This is a paper about inflation. Inflation is perhaps one of the most fundamental sources of macroeconomic risk, and perhaps it is a very popular, most popular topics of the time. In the recent months, the financial market has been highly sensitive to inflation news, and there has been enormous discussion on the market about what assets are good investment instruments in the time of inflation. For us asset pricing academics, it is always challenging to identify macroeconomic factors that matter for investors and for their compensation. Especially after 40 years of mild inflation, we almost forgot that inflation is one of the key macro factors that matter for asset price. And perhaps the recent experience reminds us the importance of inflation. So this paper will tackle with the classic question of which assets can protect against inflation and what is the cost of inflation hedging. The conventional wisdom holds that currencies, commodities, and real estate, they are inflation hedges, while stocks are considered as real assets too, because their value rise with inflation. As for the price of inflation risk, it is ambiguous in the literature. If we look at the bond literature, we get a negative price of risk. But if we look at other asset classes, the result is less conclusive. So what do we do in this paper? We decompose inflation into its core and non-core components. In particular, we focus on the energy part of the non-core component. We use data from 8 asset classes and show that the conventional wisdom only tells part of the truth. Here are the main findings of our paper. First, we revisit the inflation hedging properties of different assets. Unfortunately, we find that none of the 8 asset classes, including stocks, bonds, currencies, commodities, and etc., can hedge against core inflations. The conventional real assets only hedge against energy inflation. As for the price of inflation risk, we find that the core inflation carries a negative risk premium, and moreover, the magnitude of the core inflation risk premium is consistently estimated within and across asset classes. These findings provide new insights on the driver of the changing stock-bond correlation. In the second part of the paper, we propose a 2-sector New Keynesian model that can qualitatively account for these facts. This paper is related to several strands of literature. There has been a very large literature on inflation hedging and inflation risk premium. In contrast to this work, we utilize a large cross-section of assets from different asset classes to robustly estimate a core inflation risk premium. The paper is also related to the literature on equilibrium models of inflation, macroeconomy, and asset prices. In our paper, we will propose a 2-sector New Keynesian model to make sense of the new facts we find. And our paper also speaks to the literature on changing stock-bond correlation. And in our paper, we will provide a new explanation based on our empirical findings. And lastly, our paper is related to the literature on commodity prices, inflation, and other asset classes. Now let me jump into the empirics. First, let me give you some summary statistics about inflation. The headline inflation, or the CPI, has 3 components: core, food, and energy. Core inflation is just the headline inflation minus food and energy. All 3 components have similar averages, about 4% per annum. But the energy inflation is much more volatile and less persistent than core inflation. If we look at their contributions to the headline inflation, well, core accounts for about 70%, while energy accounts for about 10%. Although energy only accounts for a small share, it is very volatile. So its contribution to the overall headline inflation fluctuations is still very important. There are many episodes in which the headline inflation is mainly driven by energy inflation. To conduct the asset pricing exercise, we need inflation shocks. So we extract inflation shocks through a vector autoregression. Here, the UT are considered as inflation shocks. The variables that are included in the vector includes headline inflation and its three components, the log price dividend ratio of the aggregate stock market, the risk-free rate, and the output gap. This figure shows the time series plot of the shocks to headline inflation and its three components. We see that the core inflation is more volatile in the first half of the sample in the 1970s and 1980s, while afterwards it becomes very stable. This is perhaps a result of the more transparent and active monetary policy. In contrast, energy inflation becomes even more volatile after the 1990s in the second subsample. This is an important observation that leads us to our new explanation of the changing stock-bond correlation, which I will detail later. In the literature, many papers use survey data to measure expected inflation. And despite having a shorter sample, we did it too and find very similar results. For the test portfolios, we utilize a wide and the standard asset classes. So there are 8 asset classes: stocks, treasuries, agency bonds, corporate bonds, currencies, commodity futures, REITs, and international stocks. To highlight the across asset class nature of our exercise, we first use an average portfolio in each asset class. And today I will mainly show you results with these average portfolios. And then we bring in richer portfolios by introducing a cross-section in each asset class. And this in total gives us 38 test portfolios. And later, we include an expanded cross-section in each class for within asset class study. This figure shows our first important result. We regress the excess return of each average portfolio onto the shocks of headline, core, and energy inflation. For headline inflation, we run a univariate regression, and for core and energy, we run a bivariate regression. The purple bars show the point estimate and the confidence intervals of headline inflation betas. It somehow confirms the conventional wisdom. Bonds are negatively exposed to inflation. Currencies and commodities, they have positive inflation betas, so they seem to be good inflation hedges. Stocks, REITs, and international stocks, their inflation beta are close to 0, sometimes negative, but statistically insignificant. Things look very different when we include core and energy separately. For the bonds, they're negatively exposed to both core and energy inflation. But for stocks and the REITs, they have sizable negative core betas, and their energy betas are positive and statistically significant. So this explains why we get a close to 0 insignificant headline beta for stocks, because these two betas have opposite signs and offset each other, which obscure the effect of inflation on asset prices. For currencies and commodities, we find that the inflation hedging property of currency and commodity only come from hedging against energy inflation. Neither currency nor commodity can hedge against core inflation. Next, we explore whether inflation risk factor can explain the different expected returns across these asset classes. So the model implied expected return is the price of risk times the return exposure. And here, first, we include the headline inflation risk as a single risk factor. This figure shows the empirical fit. The vertical axis is the average excess return of each portfolio in the data, and the horizontal axis is the model predicted expected return. That is the lambda times beta. We see the fit is very poor. Stocks and bonds and the currencies, they have very dispersed average returns in the data, but the model implied expected returns are very close and centered around 0. We have the same pattern when we include more portfolios for the 38 portfolios. And again, we see the empirical fit is pretty poor. We have a very different figure when we include core and energy separately. The average access returns in the data and the model implied expected returns line up almost perfectly on the 45-degree line here. Stocks and the REITs have high returns in the data, while the model predicts that they have high expected returns. Bonds have low returns in the data, and the model predicts the same. Even when we have 38 test portfolios, the fit is still superb, and the R-square exceeds 80%. To estimate the inflation risk premium within and across asset classes, we construct the factor mimicking portfolios of core energy and headline inflation. We follow the approach of Fang and Macbeth to construct the portfolio weights as beta beta prime inverse times beta, where the betas are the first stage estimates. So in the next paper, Alejandro will talk in greater detail about this methodology. So I will be brief here. So the first 8 columns are the statistics of the factor mimicking portfolios constructed from each asset class. And the last 2 columns are the statistics of factor mimicking portfolios constructed from the 8 average portfolios and the 38 portfolios. For the core inflation mimicking portfolios, the average returns are pretty close to each other, around -1%. And all of them are statistically significant except for the commodities. But if we look at energy and headline, they don't look so stable and sometimes even switch signs. For energy, the price of risk seems to be positive, but not very stable and significant. And these results are robust to controlling for standard macroeconomic factors, including consumption growth, durable consumption growth, and IP growth, and etc. Now let's come back to stocks. The relation between inflation and stocks perhaps has attracted the most attention in the literature and from the market participants. Recall that the stocks have a very sizable negative core betas. What is the underlying mechanism? Fang, in his seminal paper in 1981, proposed this proxy effect hypothesis. That is, the stock return inflation relation is due to inflation proxying for real economic variables. We run the predictive regression of core and energy, headline core and energy inflation onto future growth of GDP, consumption, and dividends at both 1 quarter and 1 year horizon. We indeed find that core inflation, a higher core inflation contains negative information about future growth of consumption and especially corporate dividends. But for energy inflation, it doesn't seem to contain any information about future growth. So this is consistent with Fang's hypothesis. To formally disentangle cash flow versus discount rate news, we follow the standard Campbell procedure to decompose the return news into cash flow and discount rate news. And then we examine the exposure of these two separate components to core and energy inflation. For the aggregate stock market, the negative core beta comes from both cash flow and discount rate news, and seems that the discount rate news is slightly more important. And for the positive energy beta, it only comes from the discount rate news. We do the same exercise for the value growth stocks. So we see that the growth stocks negative core beta mainly comes from the cash flow news, but the value stocks core beta mainly comes from discount rate news. If we put them together, the value and growth stocks actually have very similar negative core betas. The second possible channel of the negative stocks core beta is through the Fed response. When there is a high core inflation, the Fed raises the policy rate, which depresses the stock returns. To evaluate this channel, we use high-frequency data around inflation announcement from 2 minutes before the announcement to 20 minutes after the announcement, and we look at the change of Fed funds future price and the stock future price. In panel A, we examine whether Fed indeed adjust the policy rate in response to inflation response. And we do find that if there is a surprise core inflation, the Fed will raise its policy rate. And the magnitude is much larger for core inflation than headline inflation. And in panel B, we examine the effect of core inflation and headline inflation surprise, as well as the Fed policy change to the stock future price change. We find that all three components contribute to the decline in stock price. But the last row shows us that while the Fed response indeed accounts for some of the stock return decline, it's not the whole story. Even after controlling for the Fed funds future price change, the core inflation surprise still has a very sizable negative coefficient on the stock price change. Next, let me talk about the stock-bond correlation. The literature has shown that the stock-bond correlation turned from positive to negative after 1999. So following this literature, we split our sample into two subsamples. The first subsample goes from 1963 to 1999, and the second subsample goes from 2000 to 2019. In both subsamples, bonds are negatively exposed to inflation, but in the first subsample, the stocks are negatively exposed to inflation, while in the second subsample, the stocks have a positive headline inflation betas, and the change is statistically significant. If we look more closely, this change mainly comes from the energy component. We don't really see a statistically significant change in core beta for both stocks and bonds. But for energy, the stock's energy beta changes from negative to positive in the second subsample. And more importantly, recall that in the second subsample, the energy inflation is more important in the total headline inflation. That helps us understand why stock-bond correlation changes sign at the turn of the century. In the first subsample, core inflation is more important, and the stocks and the bonds are both negatively exposed to core inflation, so their returns co-move positively. In the second subsample, energy inflation is relatively more important. Stocks are positively exposed to energy, while bonds are negatively exposed to energy, so their returns co-move negatively. So to conclude our empirical section, when we talk about inflation hedging, an investor might not only care about hedging against unexpected inflation, but they might only think about hedging against expected inflation. So in this table, we include both the expected core inflation and the core inflation shock in the regression. For energy, since energy inflation is not persistent and less predictable, so we just include the energy inflation level here. We see that none of these assets have a significant exposure to the expected core inflation. And these are the excess returns of these assets, okay? So perhaps the risk-free rate already has incorporated all the information about expected core inflation. And the coefficients of core shock is very robust after the inclusion of the expected component. So these are our empirical facts. Now let me get into the model. We try to propose a variant of the very simple New Keynesian model to make sense of these facts. The model is meant to be stylized and qualitative, and we try to get the minimal set of ingredients to make sense of these facts. Households are pretty standard. There is a representative agent that get utility from consumption and disutility from labor. Consumption is a CES aggregator of the core good and energy good. These two goods are aggregated in with a constant elasticity of substitution, and phi is the elasticity of substitution. Energy good is subject to an energy-specific demand shock. The core good consumption is, again, a CES aggregation of different varieties I. And epsilon T here is the elasticity of substitution across these varieties. The energy goods are endowed exogenously, which captures the inelastic feature of energy supply. The interest rate follows the Taylor rule and responds to core inflation. This is consistent with our evidence before that Fed mainly responds to core inflation surprises. The firm side is also pretty standard. The core good producers, they are monopolistic in each variety, and each variety is produced with labor under a decreasing return to scale production function. These firms face price rigidity and optimally set the price. The sticky price assumption is consistent with our evidence. We do find that core goods inflation are more sticky. So we compare the core inflation index with the sticky inflation index provided by the Atlanta Fed. We find very high correlation between the two. And the core inflation and the sticky inflation, they share similar property of inflation hedging and inflation risk premium. So we log linearize the optimality condition, and that gives us a New Keynesian Phillips curve. The core inflation today depends on the expected core inflation tomorrow, the real marginal cost of production, and the desired markup. So in our model, we treat the desired markup as an exogenous force that drives inflation dynamics. So markup shock here, we treat it as a modeling device for inflation dynamics following the DSGE literature, for example, the Smets and the Walder's paper. So we do not provide direct evidence on markup shocks. To solve the model is pretty straightforward. All the endogenous variables can be solved as a linear function of these three exogenous state variables after log linearization. And we can do the same for the real stochastic discount factor. The asset prices are solved using the Euler equation. And the goal of this model is to determine the sign of the coefficients in blue. The equilibrium of this economy is characterized with two equations. The first equation is the Phillips curve, or the aggregate supply curve. And the second equation is the dynamic IS curve, or the Euler equation, or sometimes we call it aggregate demand curve. The intersection of the two leads us to the equilibrium core output and the core inflation. Now let's think about a markup shock. If there is a positive markup shock, firms set higher price, so the Phillips curve is shifted to the left. And the equilibrium core output goes down and core inflation goes up. So when core inflation is high, that is a state with lower core output. That is a bad state of the world. So the price of core inflation risk is negative. Next, we try to solve for the asset price exposures to the inflation risk factor. When there's a high inflation, core output goes down, core firms' dividend goes down, and moreover, the discount rate goes up because the Fed responds to the higher core inflation by raising the policy rate, both of which depresses stock returns. So stock returns go down in high core inflation times. For the bonds, well, when inflation and its expectation goes up, bond return goes down. That is pretty standard. For the foreign currencies, since the high inflation state is a bad state of the world, so the domestic real SDF goes up and the domestic currency appreciates in real. Although a higher inflation depreciates the nominal exchange rate, but the real effect dominates the nominal effect. So this is different from the logic of the purchasing power parity. So in the bad state of the world, foreign currency depreciates. For the commodity futures, we define a commodity future, a future contract written on the energy good. And the exposure of commodity future price on the core inflation is ambiguous. On one hand, core output goes down, which makes it more scarce, so the relative price of energy good should go down. But the overall nominal inflation goes up. So which force is dominant depends on the parameter choice, and we don't have a particular stand on that. And recall that in the data, the exposure of commodity futures to core inflation is statistically insignificant and hard to identify from the data. Next, let's look at the energy shocks. There are two energy shocks, a demand shock and a supply shock. We can show that the demand and supply shock have similar effects on the real variables and the asset prices, but they have opposite effects on energy prices. A positive energy demand or supply shock increases the marginal utility of core goods if the core and energy goods are substitutes, which is an assumption in our model. So it will shift both the Phillips curve and the dynamic IS curve. For the Phillips curve, the higher marginal utility of core goods will induce a lower wage, so that the Phillips curve will shift to the right. For the dynamic IS curve, if the marginal utility of core goods is higher today, that induces a higher aggregate demand, and that leads to the dynamic IS curve to shift to the right. So if both curves shift to the right, the equilibrium core output will go up. In this sense, the energy shocks, both supply and demand shocks, are expansionary. However, they have opposite effects on energy prices. A positive supply shock lowers energy price, and the positive demand shock raises energy price. When we think about the price of energy inflation, we can write it as a weighted average of the price of energy supply shock with a negative sign and the price of energy demand shock. That explains why the price of energy inflation risk is hard to identify from the data, because there are two offsetting forces here. And the same is true for the assets exposures to energy inflation. Again, the betas can be written as a weighted average of the exposures to energy supply shock and energy demand shock. In our evidence, we show that in the second subsample post-2000, the energy betas for stock returns and foreign currencies, they are positive, and that leads us to infer that the energy demand is the dominant driver of energy price fluctuations post-2000. So to conclude our paper, we shed new light on the nature of inflation risk by decomposing inflation into core and energy components. We show that the conventional inflation hedges only protect against energy inflation, but not the core. And the core inflation carries a negative risk premium. And moreover, the magnitude of the core inflation risk premium is consistently estimated within and across asset classes. These findings provide new insights into the changing stock-bond correlation. And in the second part of the paper, we propose a two-sector New Keynesian model that can qualitatively rationalize these facts. And our evidence suggests that energy demand is the dominant driver of energy prices post-2000.